Today, Trishul is going to share his fire calculation from 20 years ago.
Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Agti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Agti. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today, and thanks everybody for listening and watching.
Great to be here as well. So not that long ago, Trishul mentioned that he had put together a spreadsheet when he was in his 20s about how he could achieve FIRE, like how much he could save each year, how that would grow. And as he was playing around with it, he realized if he saves more and gets more growth, he could achieve financial independence even sooner. And today we're going to take a look at that spreadsheet. And it's going to be our context for trying to help really understand the compounding benefits. Like one is the savings aspect, like how much you're saving, but then also how compound growth really works and really helps you get some pretty impressive results down the road. So Trishul, let's kind of kick it off. Do you have the actual original spreadsheet, or did you like recreate it?
No, I don't have the original, but I think the one I'm going to show is probably 90% there, not too far off. Obviously, I'm better at like formatting and displaying things than I was in the early 20s, but this is very close to it. And this is actually a spreadsheet that I share with my clients, because often when we start talking about financial numbers, it gets a little complicated if you jump to the big plan, which has like thousands of numbers and all these bells and whistles and moving parts. I really want my clients to understand just the intuition behind compounding and present value and future value and things like that. We'll get into all that, but that's what hopefully the spreadsheet can provide. And just a little Yep.
That's a great point. I want to make sure we're clear. For people watching, we have kind of tried to do some edits to make it a little more visually appealing. And for people listening, you're going to have to hear us describe a spreadsheet, and I apologize in advance, but we have tried to simplify this from a formatting and visual perspective, just to make it a little more intuitive and easier to understand.
Yeah, that's the caveat I was kind of getting to. And then, we'll try our best to make it also followable, from the audio version. And, at the same time for the listeners, I'm happy to share a version of this somehow in the show notes in case anybody finds it useful.
Okay, so if anyone wants a Excel spreadsheet with only like 5 or 6 inputs, you could email Trishul.
All right. Well, don't email me. Sorry. I'll put it in the show notes.
Okay.
I'll upload it somewhere.
Okay.
You got to figure out your own Excel or however you plan on opening it.
That's actually one of those like good life skills, I guess I'd say. Like, this is not that complex of a spreadsheet. I think it's part of the point of the conversation is like figuring this stuff out. Just the math is not particularly difficult.
Yeah.
And spreadsheets just allow you to like iterate calculations over 20 years.
That's it.
And so if you don't know how to use Excel and spreadsheets, this is a really good way to learn.
Sure. Yeah. This might be one of the most useful things that you can do in Excel at a very simple level.
Yes. I could probably give this to my middle school daughters to kind of, here's your intro to Excel.
Yeah, it's a great intro. You're right. That's a good point. I'll get my 7-year-old on it.
Okay. Do you want to share this up? So again, you created this in your early 20s.
Yeah.
And I'm going to ask you to kind of share just some of the math, but also like, how did it actually go? Like, here's what we thought that from 20 to 40 would look like, or you'll share the ages, and then we'll share like how did it actually go, kind of thing. So, okay, I'll let you get to it.
Okay, so again, I'll talk to most of this, and we'll try to keep it simple. I'm gonna share the screen, so maybe this is one of those episodes where checking out the YouTube could be helpful, but we'll do our best as well for the audio listeners.
Okay.
All right, here we go. So adding this thing. All right, let me know if you see that, Aaron.
Nope, not yet. I think
Yeah.
you went like.
Yeah.
Oh, and you went that one. I think. No. Oh man, we're not good at this.
It's okay. Apparently,
There
you
we
can
go.
only
Okay,
share
I
one
can see
thing
it.
at a time. So now we got both. All
Okay.
right, so maybe we're going to sneak away ourselves, Aaron. Is that okay? I'll look
Sure,
it up.
that's fine.
Is that fine?
Yeah, I like that one. I like that one. There we go.
All right, so the basics of present value and future value and time and money and all that is you need an effective way to move money through time, right? Things happen when you move money through time. When you push money forward in time, it gets less valuable because of inflation. You got to think about that. But also when you push money forward in time, it can potentially grow. So you got to think about how do you calculate that effectively. And this is probably one of the most important concepts in finance because a good amount of finance is pushing money through time and seeing the impact, right?
Okay.
Um,
So just, do you have a financial calculator on your desk right now by any chance?
it's behind me somewhere.
Okay.
Yeah.
So this is one of the things that I think I have the same exact one I had from college. But yes,
Yeah.
the
You got the TI, what is it, 82?
BA2 plus.
Okay, yeah.
The
Can you
TI
show it?
82 is the graphic. Sure. That's this one.
Oh yeah,
So it
no, that,
has the same uh NIY PV payment future value,
yeah,
like exactly what you have in the Excel spreadsheet.
right, exactly, yeah. So all financial professionals will probably have some sort of calculator like this on their desk for pushing
They also do
money.
happen to have like apps that you can put on your phone now that are work exactly the same.
Yeah,
Uh,
and we'll show the math is really just algebra. Like it's nothing really
yeah.
beyond that. Um, but it's
So
very important. Like you imagine, like the whole profession of stock valuation is figuring out how much money will this company earn over the rest of its life, and adding all that up and discounting it. Right. That's how you figure out a stock price, or like
okay,
a merger deal. Right. That's just figuring out how much is this company valued. Right. So it's
okay.
it's all basically time value of money.
So again, for listeners, I'm looking at the spreadsheet. I see very simple retirement calculator, the current portfolio value, which we might want to rename the A2 column because PV stands for present value. So
Yeah.
like current investment value or something like that. But PV is present value, and we're going to start with $1,000.
Right.
Our investment return after inflation, so is our R. That's our rate of return. That's the common abbreviation. We have it 7.2%.
Yep.
We're going to do years of savings is our N. So N is just the number of years or number of iterations that we do it.
Yeah.
And our future value, so in this case, we have labeled it future portfolio value, our FV is our future value. It does the math for us of if we have $1,000 growing at 7.2% per year for 40 years, we end up with $16,000.
Right. Yeah.
Do you mind changing your 40 to 1? Like I want to kind of just illustrate
Yeah.
this. Like, so this is like a really good example. If you have $1,000 and it grows at 7.2% for 1 year, you end up with $1,072 because 72 is 7.2% of 1,000.
Right.
So it's doing the math for us of, okay, if we change our N to 2, now it's not 1,000 growing with an extra $72. It's now 1,072 growing at 7.2% of that new number.
Yeah.
So we've got a little extra growth on our growth.
Yeah. And the math is really super simple. All you're doing is you're taking the $1,000 and you're multiplying it by 1.072, which is just 1 plus 7.2%.
Yes. That's a good.
And then you're just raising it to the power to the number of years that you want to compound for.
I almost wonder if you can like draw like the super math of like because that's when like you learn that in any finance class from the
Yeah.
very beginning.
It's
Future
right
value
here. Can
equals
you see that,
value.
Aaron?
Oh yeah. Okay.
Right.
Future value equals present value times 1 plus r to the n.
Yeah. Right.
And so again, the way it works is our 1 plus r is where we get kind of future value plus, so it's our 1,000 plus the 7.2% of 1,000. So our r's times that, and we can simplify that. And then we multiply each one of those times how many years we have. So 2 years would be 1,000 times 1.072 times 1.072. So because we have 2 of those, we can square that. So we get this, our exponent of the years we do.
Right. Yeah. So we're just raising it to the power of the number of years we want to compound for.
Yeah.
Raising 1.072.
Yep.
Okay. So now 10 years, interestingly enough, 1,000 compounded at a 7.2% return doubles, right, to 2,000 after 10 years. We've talked about this many times. This is known as the rule of 72 because it's 7.2% to get that doubling. And the very interesting part is this is the after inflation return if you use a large amount of historical data of the market, essentially. So this is data, for example, I even went back and calculated this over a 150-year period, and it's pretty much about 7%. After adjusting for inflation in terms of the annual return of the market. So the rule of 72 essentially says if you have $1,000, you can double it in 10 years. Or if you have any amount of money, you can double it in 10 years if you get roughly a 7.2% return.
So I actually want to play around with it. Do you mind changing the investment return to 10.2 and our years to 7?
Okay.
Yeah, that's actually like 10.3, I think, because 72 divided by 7 is 10.3.
Yeah.
But yeah. So again, this is not a strict line. I've done the math before. It's just 2 separate graphs that happen to be very, very similar.
Yeah.
And they're very similar in the normal rate of return range. So again, if we got 10% per year by rule of 72, our investment will take 7 years to double.
Yeah.
If you get an 8% rate of return, it's going to take 9 years to double. And it actually works to kind of, for 72, 8 times 9, so they're both divisible. And then also 6 and 12 make up 72. So we have kind of quick, easy math for 6, 7, 8, 9, 10, 11, 10 and 12.
Yeah. The other way I like to think about it is you have $1,000 and pretend you got a 7% return over 10 years. Well, 7 times 10 is 70, so you should get at least 70%, right?
Yeah, so it'd be
$700, right, on your 1,000, and the extra 300 is compounding, right?
Okay, yeah.
So that's just money or interest on interest that you earned. That's why it's that's why interest is so cool, right? You're earning interest on the interest. You're earning return on the return.
Yes.
Yeah. So and then you can just double the period. So let's say you had 20 years. So now your 1,000 goes to 4,000, right?
Yeah, because we've doubled twice now.
Yeah, and double it 3 times, 30 years. You got $8,000. 40 years, double it 4 times, the $1,000 goes to 16 grand. And this is basically where I echoed that number in one of the episodes, 1 or 2 episodes ago, of how you can 10x your money over 40 years, roughly. It's actually 16x, but I say 10x because maybe you don't get the full 7.2%, right? Maybe just some weird things happen. Maybe you got to pay taxes or slippage or whatever it happens to be. But 10x is quite reasonable, right?
Yes.
That to what you might expect over a 40-year period.
I like that. So we got rule 72, and we got if we use 7.2% rate of return, which is actually a very reasonable after inflation return on a stock market, then we'll have doubled in 10 years. And I don't know the Latin for 16, so it's like we've now 4x, 8x, and 16x our money over 2, 3, 4 decades.
Right. Yeah. And you can do this math. You can pull out your calculator. You can take 1.072, raise it to the power 40, and multiply by $1,000, and you'll
Whatever
get
you start with. Yeah.
16,136. Yeah.
Yeah. Actually, the math
That's
was
it.
like you start with 1 and you'll end up
Sure.
with $16.
Exactly. Yeah.
So it can make the calculators a little easier.
Yep. There you go. Okay, so that's the simple math of moving money from, current day to the future day. Now, you just say one more time where inflation is already baked into this because the return is after inflation, meaning this is in today's dollars, right? That you get this 16x.
So the other thing I want to do was that we had $72 times 40. So of our 16,000, 2880 is that like the nominal interest. We started with 1,000, so 3880 is kind of the easy money. Like if we didn't get compounding, so now we have 16,000. So it's like 12 grand is the compounding benefit.
Mm-hmm.
So like that's once you add more years, 75% of this future value comes just from compounding.
Mm-hmm. Mm-hmm.
Okay.
Okay.
So what's next on your spreadsheet?
We're going to call this the very simple calculator. So now we're going to have something that's slightly more complicated. We're going to call that just the simple calculator. And all we're doing is the same exact math, but just adding some bells and whistles. Nothing too crazy. So in this scenario, basically what we're going to show is, let's pretend you're 25 years old. That's what scenario 1 is showing in this top row or the second row. And let's say you save for 40 years, a typical retirement timeline. You're 25, you save for 40 years, you're going to retire at age 65. We're gonna say what if, right? And then we're gonna compare two scenarios. Scenario 1 is what if you get a 3.5% return, and scenario 2 is what if you get a 7%. The reason I picked these two numbers is the 7% is that aggressive case where you're fully invested in the stock market, right? And you're getting that 7.2 return. I've made it 7, but it's pretty similar. And then the 3.5% is what if you're 100% bonds, right? And you just get the bond return. What we're kind of saying here then is roughly most people will be between these two scenarios. You're either going to be fully in bonds for the next 40 years, or you're going to be fully in stocks, or some combination, right? Mm-hmm. All right, so the very simple math before we get to the more complicated math is just expressing that rule of 72 again. So what we're showing here is if you're 25, you save for 40 years, age 65, you start with that same $1,000, you get the 7.2%, you'll end up with that 16 grand, right?
Yep.
So no crazy back of the napkin switcheroo going on, right? It's just what we talked about before.
Yes.
Now, here's the key though. If you were fully invested in bonds, stocks, you get the full 16 grand. But what if you were very conservative and you decided to just fully invest in bonds the whole time? Well, you're not going to end up with 16x. You only end up with a 4x, right? So you got half the return, but you only ended up with about a quarter of the upside. The half of the return per year, right, let you give up 75% of the upside.
So in this case, rule 72, it once you get farther away from that like 6 to 12 range, it gets a little less accurate.
Yep.
But it would take 20 years to double. And so we kind of see that here. It's going to double in 20 years, 4x in 40 years. So that's kind of lining up with our expectation of half the return took twice as long to double.
Right. But you can see how the divergence in the amount of time it takes to reach your goals gets exponentially harder by taking half the amount of return, right?
Correct.
So in order to catch up, you're going to have to spend a very long time to match the 16x, right?
Yes. So in this case, if you're trying to match the 16x at a 3.5% rate of return, yeah, you'd have to double the years, go from 40 years to 80 years.
Yeah, right. So this is part of why I say it's also important to take on an appropriate amount of risk, right? If you take
Yeah.
on too little, you just may not get there. We don't have 80 years, right? In many cases.
Yeah.
So to size the amount of risk appropriately, it's important to understand what's the opportunity cost of not taking that risk. And it can literally mean like 40 years of
Yeah.
waiting, which not everyone has. Okay,
Okay.
so now,
So we got,
yeah,
so again, we've expanded out. It's like trying to relate that very simple calculator to a potential real scenario. So now our it's not instead of like n is 40. Well, yes, n is still 40, but now we're thinking age 25 to age 65. That's
yeah,
how we're getting our 40 years.
right. Now let's add in something a little more complicated. So that what we've been talking about so far is you start with a certain amount. What's that amount in 40 years, right?
Mhm.
Now, but when you're working, you're going to actually put more money in every single year, right? You're going to
Yeah.
allocate X amount this year and X amount next year and so on. So now let's make this a little bit more nuanced and say, what if you save an additional $1,000 every single year for the next 40 years?
Mhm.
So at year 0, you start with $1,000. You know, maybe that's your starting point at age 25, your signing bonus, right? You get $1,000, and you're gonna see it's not trivial in terms of the impact. And what if you also at the end of every year for the next 40 years invest another $1,000? So now you're gonna invest effectively 41,000 if I can add my
Yes.
41,000
Correct.
correctly. And you're going to have it grow over these two scenarios. First, growing at a very conservative rate of 3.7% or half the 7.3% or 7.2% annual return. And let's see what they come out with. Okay. So a 25-year-old saving for 40 years, retiring at age 65, if they just put in $1,000 a year, starting with $1,000, they'll end up with about $250,000 at age 65, about $232. So, how do you become a quarter millionaire, right? You save
You save
$1,000 a
1,000 a
year
year.
for 40
Yeah.
years, essentially. And you can multiply these numbers. How do you become a millionaire? Well, you effectively, whoops, wrong one.
Yep.
Multiply everything by 4, right? So you save $4,000 initially as your signing bonus, and each year you save $4,000, right?
Yeah.
Over a 40-year career. So, if you want to be a millionaire by age 65 and you're 25 and you got $4,000 to put away each year, this is how you could do it if you get that full market return or full
Okay.
market average return.
I think that's where we want to add our caveat. Because our investment return is after inflation, our future portfolio value of $1 million is also in today's dollars.
Yes, absolutely.
Realistically, you would get there sooner because you're getting what's called the nominal rate of return. So we're assuming it's like a 10% rate of return on the stocks.
Yeah.
So you get there sooner, but it doesn't have the same purchasing power as $1 million today.
Yeah. It'll be about 2 million roughly, right? At age 65, but it will
Over
be
40 years, yes.
Yeah, it'll have the spending power of $1 million.
Yes. And I think that's actually I like that you have the bonds in there as well, because it's also it's a little higher than a return an inflation assumption, but not by much. And so you have 3.7% after inflation. Sorry.
Yeah,
But
so bond returns are around 5%, 5 to
yeah.
5.5% over long periods.
So
Nominally.
if we changed scenario 1 to be inflation at like 3%,
Okay.
And scenario 2 is nominal return of 10%. It kept everything the same.
Mm-hmm.
We can see that saving $4,000 a year for 40 years, we have almost 2 million, but we've lost like 300 grand to inflation, to purchasing power. Would you agree with that? That kind of no, that doesn't, that should translate. Yeah. Does that feel right to you? Or is it as a savings? Yeah, it's the so take out annual savings.
Yeah, I don't think that might be correct, because there's some compounding that you're also giving up on the inflation as well. Like, you get compounding on the growth. I don't know if we should get too much into the weeds, but
because it'd actually be like a inflation just be like nominal return divided by.
Yeah, so you don't just lose inflation, you lose more than that, because you lose the growth on that inflation. But again, that might be a level 2 in terms of
okay. Not as because it's also like technically you don't subtract inflation. It's what 1 plus n over 1 plus r 1 plus I for inflation.
That's why I think if you stick to just real returns, and then you just know, right, this is in today's dollars, everything. Yeah.
Yes, but I do want to point out, like, so yes, I agree to try to keep it a simple retirement calculator, keeping it in today's dollars.
Yeah.
Yes, that makes sense. But the actual dollars you would see in your account will be $1 million sooner.
Yeah, that's true. You'll be a millionaire sooner. It just won't feel like a millionaire quite like how it does today.
Correct. Yeah. Even though a millionaire today doesn't feel like a millionaire 20 years ago.
That's true too. Yeah. Okay, so here's the hitch, here's the key thing, insight, right? Let's say you do this. You save the $4,000 per year for 40 years, and you're a millionaire in today's dollars even, but you're 65 now. And what does that mean? Well, using that 4% rule that we've talked about many times, what data suggests is you should be able to pull out 4% on a go-forward basis from this $1 million. So basically, your retirement income would be about 40 grand.
Yeah.
Right? So if you estimate that you would need about 40 grand to survive a retirement, well, this is how you get there, right? You save about $4,000 a year.
So, super rough math. You make 60K. You are saving 4K. You're spending 40, and 16 goes to taxes. Probably that's higher tax rate based on 60K income than that would be realistic. But if you want to recreate your lifestyle at 40K per year and you earn 60K, then you save 4K per year.
Yeah. And, the other thing to realize, though, is if you're fully in bonds instead of being fully in stock, you'll only have about $350,000, right? You'll need to work much longer to get there. So 2/3 of the money is by taking on that extra return, right, of being 100% invested in stock. Now, of course, you could be anywhere on the spectrum, meaning instead of being fully in bonds or fully in stock, you could say I'm, some percentage of stock and bonds, and you can see the impact of that, right? We'll look at that on the next slide. But as far as a very simple calculation, this is roughly what you might be targeting. Now, here's where things get interesting. Like, now you can play around. What if you save more and you want to target an earlier exit? Meaning, what if you want to be a millionaire sooner, like in your 30s or, age 40, let's say
Okay.
15 years,
Okay.
right? How much would you need to save per year to become a millionaire by age 40 if you start at age 25 over a 15-year period? Okay, so, we can kind of back into this number. Whoops, I'm changing the wrong thing. Fun with real time.
Yeah. Go and change your current portfolio value to
25.
To sure.
Okay, we're getting there. I should do this.
I don't think your current portfolio value matters as much as.
Yeah. I'm just trying to keep it simple. Okay, so it's about 35 grand. All right.
Okay.
So if you save 35 grand per year and you get a 35 grand signing bonus on year 0 for 15 years, you'll be a millionaire at age 40. Okay.
So now we're trying to say, okay, you're spending 40, you're saving 35. So if you made, I don't know, 100K, you're paying 25K in taxes, you're spending 40K and saving 35K.
Yeah.
You can be financially independent in 15 years.
Yeah. So basically you're saying I'm going to save 35% of my income for the next X amount of time, 15 years.
Correct. And so like that, when you were making 60K and you're saving 4K, you're saving 7% of your income?
Mm-hmm.
So your income went up, your expenses you kept your lifestyle the same, and your savings went from 7% to 35%.
Mm-hmm. Mm-hmm.
That's how you get that. That changes it from you're financially independent at 60 down to financially independent at 40, or sorry, 65 down to 40.
Mm-hmm.
Change a 40-year time frame down to a 15-year time frame.
Yeah. Yep.
And that's what you see with those trying to pursue FIRE is you also need the income to support savings levels that high.
Yeah. And we'll see on the next page just a little bit more nuance of, yes, certainly income is going to go up, or it will in many situations, right?
Yeah.
And if you do keep lifestyle creep under control, then you may be able to save a larger percentage of your income over time, and that can have its own compounding impact. But before we get to that, I also want to point out one thing. We mentioned if you're at age 65, then you take a 4% of that million and you got your 40 grand, and you get to adjust that 40 grand for inflation every year going forward until you die. The caveats there again are that data was looking at backward-looking historical data to come up with that 4% rule. It also wasn't 100% bulletproof, but it was like very close to that, meaning not every single historical scenario, but the vast majority of them. But the other thing is, if now you're targeting to become financially dependent in your age 40, you have an extra 25 years to think about. So pulling out 4% could be a little too aggressive. In fact, the data suggests it should be closer to 3% if you're targeting an extra 25 years of pulling out data, meaning on that $1 million, you could probably target inflation adjusted income at age 40 on a go forward basis of not 40 grand, but 30 grand.
Yeah. So,
right? Yep.
It's, and like if we bumped but now let's bump your savings up to 40 grand. And
sorry.
By 45. Yeah.
Yeah. So basically, if you want that 40 grand, then you're going to have to save about 1.3 million, meaning you got to put away 45 grand instead of 35.
Yeah. So now again, and that still might be feasible because on like your 100K income, you're probably not paying 25K in taxes.
Probably not. You should be paying like 15%, something like that.
I would say as a 15 federal, you can probably another 5+ state if you're in California or New York.
Or 0.
I would have said like 12% federal, 12 to 15% federal, 4 to 6% state.
Yeah.
So you're probably saving 45K. It might be hard to save 45K and live off 40K at this level, but unless
It
it's like
could be.
all, it's
I
possible.
would say a couple of things though. There's a good amount of that should be sheltered, right? So
Yeah,
that
like retirement
45K,
accounts.
roughly all of it should be sheltered in a tax
Yeah,
shelter, meaning you're getting some sort of tax benefit. Either it's reducing your current income tax, or if it's in a raw type of
right.
vehicle, it'll reduce your income tax down the road of not having to pay on the gains.
Mm-hmm.
But in either way, you're getting a good amount of tax benefit on that, meaning you shouldn't be paying as much taxes now or in the future.
Yeah, yeah,
which could make it a little easier to obtain, right?
yes.
Okay, so this is a rudimentary FIRE calculation that you can think about, right? If you want to really target age 40, this is what it might take at
Yeah.
its very basics.
Yeah, I agree with that.
Okay, good. Now let's dig one step deeper, right? A little more nuance. So same exact math, right? We haven't even moved away from that calculation that you could do with your calculator. We're just adding more variables, right?
Okay.
So in this scenario, I call this the less simple calculator because it's less
Okay.
simple than the previous one.
Okay.
You can imagine I started with simple and then I made the very simple and then I made the less
Yeah.
simple. So here we go. So the whole point is it's the same one as before, but now with more bells and whistles.
Mm-hmm.
Okay, so now what I'm showing is what if you changed up your stock bond allocation, right? So if you're 100% stock, you'll get that full 7.2%. If you're 100% bonds, you'll get 3.5%. But what if you're something in between, like 80-30 or 70-30? Sorry, 80-20 or 70-30.
Yeah.
Or 60-40, right? The very common one. For example, that retirement calculation on the 4% rule was based upon you transitioning to a 60-40 at age 65 to be able to pull out.
I believe it is actually included a 60-40 return the entire time.
That could very well be true. Yeah.
Yeah.
There have been many incarnations of this, so there maybe isn't even one true one to point to, but roughly.
Sorry, it was a 60-40 portfolio because the math was only for retirees moving forward in every historical 30-year period.
Okay. Yep.
Yeah. So the
the Trinity study you're talking about.
No, the original Bill Bengen study.
Okay, so that's the precursor. Okay.
Yes. So they're more or less the same. But yeah, it's the once you get to to retirement age, you have however much you were able to save plus however much it grew. All the math is based on like lump sum retirement moving forward.
Okay, so it's not looking. It doesn't matter how you got there.
Correct.
It's like
correct.
You're there.
Yes.
Now you are the 60-40. So you
Correct.
could have got there by going and playing the lotto. and
Correct.
You're there.
Okay. But if you're going to retire, you should use a 60-40 portfolio.
Right. Yeah. And I think they did look at sensitivity to increased allocations and showing, the impact of that. So I guess we'll link to those studies right, in the show notes if anybody wants to geek out on them.
There's some really we're starting to get to enough research on like flexible withdrawal rates, guardrails, changing allocations in retirement, and all of those allow you to take a slightly higher withdrawal rate. And so it's kind of like if you're willing to reduce spending in a bear market, you can start higher, which means if you're 40, you could theoretically do a 4% withdrawal rate.
Mm-hmm.
But if there's a bad market, you have to be willing to cut.
Yeah.
Like the guardrails idea.
Yeah.
So I'll say it is possible to fire at 4%, but you have to know what your backup plan is, including potentially going back to work.
Mm-hmm. Mm-hmm. Yeah. So these numbers are designed to the 3% and the 4% are designed to look at worst case scenarios.
Yeah.
Or very bad case scenarios.
You have no other plan, have no backup scenario. You can never adjust your spending.
Yeah.
Yeah, it's as conservative as possible.
Yeah. And in real life, we have the opportunity to do things to
Yes,
make things
yes.
better as things change.
But those are hard to put into a spreadsheet.
Yeah.
It's not impossible. It's just hard.
Yeah. But
It would no one would call that simple would never be in the label of that calculator.
right. It'd just be called financial planning.
Yes, exactly.
Okay, so in the scenario we're seeing here is we're going to compare a 60-40 compared to a 100% bond. 60% stock, 40% bond versus 100% stock. Okay, so now what does that mean? If you just do the math, maybe just trust me on this because I'm not going to pull something over on anyone.
Okay.
The 7.2% drops to 5.6%. That's roughly what it's saying.
Okay.
Okay.
That's
so
your blended rate of return,
right,
based on that allocation.
Yeah. And now here I help some people out by saying, give me your birth year, and then I'll calculate your current age.
Okay.
So, do you want to go with you, Aaron, or hypothetical you?
No, I want to keep this at for right now. Those like 25-year-old. So
Okay.
2000. Yeah.
2000. Okay, so someone who's born in the year 2000, they're 25 years old. Now we get to say, what's your current income? You're fresh out of school. This is your first job. What's a good starting income? 50 grand.
Sure.
Okay, and let's say you get a signing bonus of some sort, or not. No. Zero signing bonus.
No. But let's say you have actually saved up $10,000 from your working before 25.
Okay, so you're not starting with debt, negative, right? You're not starting with a ton of money, but you have 10,000 saved up to get going. Okay, so now here's what we're going to think about. We're going to think about the notion that your income might be growing above the rate of inflation, right? Of course, your income will be adjusted over time just because of inflation, but you're up and coming, you're getting more experience, so you're a mover and shaker. So let's say you can outpace inflation with your experience and your diligence and your rigor, and you get 2% above inflation in terms of your income growth.
Okay.
And then we're going to see, realistically, how much can you save as a percentage of your income now? So if it's 50 grand and you save 20%, that's 10 grand a year.
Okay.
And then we're going to say, okay, how much do you want to target to pull out at retirement? We're going to ask that's a parameter. So we're going to say this person is going to work till initially, age 50s, 60s, something like that. So we're going to target that 4% number. They're going to work a full happy career of like 35 to 40 years. Okay. So now, let's see how these two scenarios play out. Now, the only difference between these two scenarios is in scenario one, this dude is conservative. They're going to take a 60-40 approach to the markets. In scenario two, this person is going to take a more aggressive approach. But nothing else is going to be different between these two individuals. We're going to see how much longer does the conservative person have to work to get the same amount of income as the scenario two person who's taking the full risk of the market. Okay, so on the next tab, we're basically showing you year by year what does the net worth of this individual look like. And then each year, we can multiply that number by that 4% to see what the potential income this person could generate based upon that net worth. Okay, so now let's start with the aggressive person and see when they hit $1 million. Okay, so the aggressive person will hit $1 million at age 52. Right?
Say again, we're saving 20% of a growing income.
Yeah. So so you're in your 20s, you say, I'm going to commit to this. Whatever my income is, I'm going to save 20%, and I'm going to target to work so hard that I get about a 2% income bump each year. What that means is in your 50s, you're going to be earning about $85K. And what it also means is you're going to be saving about 20% of that, or 17K, in your very last year. And you're going to hit $1 million at age 52.
Okay.
Okay, so that's the aggressive person. Aaron, you want to take a guess on when the 60-40 person will hit $1 million?
It's gonna be the inverse of us, like 6%. So it's gonna be
Wait, no, are you using a calculator?
okay. So I was gonna be like, what? It's gonna be 1.5 times longer. So we did 25 to 52. So that was 27 years. So I'm gonna add another 15 years. Add another 13 years. 52. I'm gonna say 77.
55, 3 years.
Oh, because we had the same rate of return. That's the part of. No, we didn't have the same rate of return. That was
No.
6.
No.
Okay,
The only difference is the rate of return.
Got it.
It's 3 years. Okay, so here's what we're saying. Let's make sure.
So our savings is the same.
Yeah, that is the only difference, right?
Yeah.
Yes, that is certainly the only difference.
Okay.
Yeah, so 3 years, or to remove any doubt, I'm just gonna make it 100.
Yeah. Okay.
And the numbers should be exactly the same. Yes. They are. Okay. So yes, 3 years. Okay, so what does that mean to somebody? So it might be, they come in and they say, "Oh, I'm so concerned about taking all the market risk. I know the market fell over 50% in 2008. I lived through that. I don't want to experience that ever again. I can't be 100% stocks. Let's do 60-40. Obviously, it's more nuanced than that, but let's say that's where we end up at. Well, then, it's important to understand that, okay, here's what you might be giving up. You may have to work 3 more years, on average.
Yeah.
Right. And then, you can ask yourself, how does that sit with you? And for some people, they might say, okay, well, it will be a smoother ride. Right. It won't be as bumpy. I could work an extra 3 years. Or somebody else might say, hey, no way. I'm not.
Yeah.
Yeah, right. 3 years, waking up, driving to work, doing all that just because I changed this one parameter, right? So yeah, it's something to think about. The impact of taking on more risk versus less risk is years of working.
Yeah.
And if you want to be even more conservative, like let's say you're taking only 30% of the risk and you're holding on to a large cash position, somewhere, and you're trying to time into that and you missed out or whatever it happens to be.
Mm-hmm.
Well, now a 30-70 portfolio, this might be closer to, this looks like it'll be
58. Yeah, because we're still getting the benefit of all the years that you're saving.
Mm-hmm.
That is it. That's why it's not as bad as that very simple calculator.
Yeah,
it's because the amount you're saving still helps a lot.
Mm-hmm. So this helps hopefully give a more nuanced understanding of the impact of risk to your your employment, right? How long you might be in the game for. Now, there's many caveats here because, again, we assumed flat rate of return every single year after year after year after year. And that's, these might average out over 40 years, right?
Excuse me.
But it could be bumpy, right? In fact, you may have some very good years early on and some less good years later on and so on, right? So that can all kind of impact that, but you can play around with this a little bit, right? To see, what if the first 10 years are good and then the next 10 years aren't and so on. But it's all back to that simple formula that we mentioned to move money around into the future, right?
Yeah.
Okay, so now let's play some fun with fire notion, right? So let's think about a fire scenario. We're going to think about 100% pedal to the metal return because we're living on the edge. But here's the 2 scenarios. In the first scenario, we're going to have this 25-year-old only save 20% of their income.
I'd probably bump up the income now. So let's say
100 grand
150.
to start.
Okay.
Okay, so person starting with 100 grand. It's you've already mentioned this many times. It's not really that important, your starting net worth, unless it's
Yeah.
substantial. So let's just say it's zero even.
Okay.
Okay, so now let's compare two individuals. One that saves 20% of their income, right?
Okay.
Still with that 2% growth above inflation on their income every
Okay.
year. And let's see somebody who saves 40%,
Okay.
right? What that means is of the 100 grand, you're going to be saving 40 grand a year in the second scenario and 20 grand
Yeah.
in the first scenario. Okay, so
So
now let's see
you're probably
when.
living off of 40 grandish in the second scenario where you're saving 40 and you have 20K going to taxes.
Mhm.
And the first one, you're probably living off closer to 60K, like
Yeah.
5,000 a month
Mhm.
after.
Mhm. So, essentially here, you're a millionaire at age 45 in the 20 grand scenario,
Yep.
right? Or the 20% scenario. Let's keep percent because it grows every year, right?
Yeah.
Roughly what that means is you're earning about 150 grand by age 45, meaning you're saving 20% of that, or 30 grand by age 45, and you're a millionaire by age 45 in today's dollars by saving 20% of your income per year, growing as your income grows. Now, the same person who saves 40 grand is a twice millionaire, right? 2 million bucks.
Yeah. At 45.
At 45, yeah. Now, since we're talking somebody transitioning to financial independence in their 40s, well, we want to target about a 3% spending rate, roughly, as a worst case.
Okay.
So what that means is the first individual will be able to live off 30 grand, maybe, right? And the second individual with $2 million can live off 60 grand, inflation adjusted on a go forward basis. So if you're age 25 and you feel like you really could save 40 grand a year for the next 20 years, then if you think you could live off 60 grand in today's dollars, right?
Yeah.
At age 45, well, that's your fire calculation. That's what you need to do for the next 20 years.
Yeah.
Save your inflation adjusted 40 grand.
So I want to use kind of rest of our time. I'm going to share a simplified financial planning outputs. We talked to like very simple calculator, less simple, and now the calculator is significantly more complex, but we've tried to simplify the variables again. Okay.
Yeah.
So for this one, it's going to be right here. Okay. So can you see this?
I think I got to remove mine. Now you got to add yours.
Oh, okay. Oh, no. There we go.
There you go.
Okay.
We're good.
Okay. So can you see Aaron and Jessica test?
Yeah. Yep.
Okay. So this is actually closer to conversation I have with clients where, say, both work in tech. I brought the incomes, I put them at 100K each, but now they both max out their 401ks. That's kind of what I'm illustrating here. And if they make 100K, saving, in this case, 23.5% of their salary is all they're doing. One of the things I like about 401k specifically is the contribution limit increases each year. Like the IRS does a pretty good job. So we are making guesses on this, but this is in line with what's been happening in the last 30, 40 years now. So I don't see any reason to think that 401k contribution limits changing. I think it's a safe assumption.
Yeah. Well,
So as a
that's
household,
essentially a inflation adjustment.
correct. Yes. Yeah, exactly. So same thing you illustrated, but I'm trying to help people translate it.
Mm-hmm.
So yes, they are saving $47,000 a year, but that does increase. Okay. This one is not inflation adjusted, so this is more nominal returns, but I still used a 7% return. So you can kind of, the numbers will still feel similar.
A
But again,
7% nominal return or real?
yes, nominal return.
Okay.
Uh,
So
but
4 or 5% real.
yes.
Okay.
So, and we can kind of see, yes, the first year you have 47,000. Second, you've saved 48 on top of that. But we have a little growth. And same thing, we go line by line. We just add our savings each year, and we have our portfolio grow at 7%. And I originally did 55. Now you have $6 million nominal.
Mm-hmm.
That's kind of the inflation adjusted idea. And that's going till 55. And the other scenario I did was 45, where now again, same savings for that time frame, and now we're getting to $2.4 million at
Right.
44.
Yeah. Yeah. So what you're showing, Aaron, is by saving the 401k amounts, right, each
Yes.
year, you're able to become a twice millionaire by age 40,
Like 43-ish.
43. Yeah.
Yeah. You become a millionaire at 37. So again, that's
Mm-hmm.
12 years of savings, 12 years of increased savings
Yeah.
plus 7% growth. And then again, we also see it's not just the 10 years to double, because we're also still saving while doing that.
Mm-hmm.
That's how we get to that 2 million at age 43. I also use this to help clients because a lot of my clients come with single company stock questions. They
Mm-hmm.
have stock options, they have RSUs, and we'll have this conversation of, okay, as long as you're maxing out your 401k, that may be enough to provide for financial independence. It can be okay to take on the risk of that single company stock, where, okay, let's say we do want to get a net worth up to $4 million to be able to have a 4% withdrawal rate of, what am I, 160.
Mm-hmm.
So we're trying to get up to that a $4 million net worth. We could try and do it earlier with company stock. So like if we get excess return from a single company stock, and that's possible, it has happened before,
More risk.
significantly more risk.
Yeah.
Now our backup strategy is, okay, then if that stock doesn't outperform the market, okay, then yes, you have to wait until you're 55,
Right.
or in your 50s.
Mm-hmm.
And so that ends up being a fairly common conversation of, as long as you're saving really, really well and increasing your savings over time,
Mm-hmm.
then that takes care of the long-term financial independence, and you have the opportunity to take on a risk somewhere else.
Mm.
And so that's why I say that this kind of get into the financial planning side. It's like, yes, this math is really, really important, but this is just a baseline. This is like
Mm.
the minimum viable scenario for a financial plan. It's
Yeah.
something you can do in Excel.
Mm-hmm.
And then as it gets more and more complex, you can start to add in, like, okay, what if we add in mortgages? Which will stay flat and end at some point? What if we add in sabbaticals, one spouse stopping working, changing jobs, changing careers, starting a business? Like, there's a lot of other things like that, but a lot of it's, and one of the big ones is you start saving as early as possible, and you're invested as aggressively as possible, and you stop saving at 40,
Mm-hmm.
but you don't start pulling money out.
Mm-hmm.
This would be like the starting a business scenario where, or
Yeah.
maybe you have some cash to decide as a runway. Like, you're not pulling money out, you're just
Right.
letting the money grow.
Mm-hmm.
And that still works out so much better than any scenario of waiting to save and hoping to get the growth there.
Right.
Like if you can start saving as early as possible and be really aggressive, that provides so much more life flexibility when you get into your 40s and 50s.
Mm-hmm.
You could decide to stop working completely, or
Yeah.
you can go down a variety of other paths because you did all the hard work early.
Yeah. Like here's a hopefully intuitive way to kind of see that. So we mentioned like that $1 million can get you 30 grand per year if you're
Mm-hmm.
like in your 40s indefinitely, right?
Yep.
And what that kind of means is, let's say you need 60 grand though.
Mm-hmm.
Well, if you get an income of 30 grand from some other means,
Yeah.
right? Well, then you can get your full 60, right? So what that means is that 30 grand of income is replacing $1 million that you would have had to have in your portfolio, right? You don't need 2 million, you just need $1 million. And, here's kind of the kicker, right? If you are able to get 60 grand, the full 60 grand somehow, from like a part-time basis, and you let that $1 million ride for 10 years, right? That million turns into 2 million. And now you get the full 60 grand.
Yeah.
And you can stop that part-time gig, right?
Yeah.
Indefinitely.
And this plays out in starting your own business, plays out in scaling back, moving to part-time, where you start out 100K, you're now making 200K, and you've saved up enough, you can go find a job that pays 50, 60K.
Mm-hmm.
And you can use investments to kind of make up for the difference.
Yeah.
So yes, I again, I think this is one of our first conversations of just how important it is to save early and invest aggressively. And I think I like going through the math as just another way to illustrate that. It really shows just how powerful it is.
Yeah. I think it's important to understand it's not wizardry. Like we showed all the math. Right?
Yeah.
There's not. It is really just algebra, but it's so powerful to have not only the ability to, you don't even need the ability to calculate it per se, but just the intuition behind how is this working and what do these knobs actually mean in terms of their impact? Because, targeting a different return rate and changing the amount of time you need to work by years, that's a big deal to understand, right? So that can make a big impact.
I think that's why I had you start with the very simple of like just 1 year and 2 year, where if you had $100, you got 10%. Next year you have $110.
Yeah.
If you get another 10%, you're not adding 10, you're adding 11.
Yeah.
And so you go from 110 to 121.
Right. Yeah.
And then you get another 10%, and now you're adding $12. And so you go from 121 to 133. And like you can see how this translates, and the numbers just get bigger.
Yeah.
But the math is simple enough that you can see that.
Yeah. And just with enough time, it really is the most powerful force in the universe, right? As Einstein allegedly said.
Do we know that if he actually said that or not?
I don't know. I like to believe he did.
Okay. We'll include the Einstein quote in our show.
Maybe it was Mark Twain. I don't know.
Okay. Well, I hope everyone enjoyed watching and hearing us talk about spreadsheets and math, because I actually really enjoyed the conversation.
Thanks, Aaron. I enjoyed this geeky conversation, and thanks everybody for listening and watching. If you are enjoying this, give us a like. Even one small like means a lot. Thanks.
Bye.
Bye.
We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, It's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.